Hey guys, welcome back. Let's just jump right in. Okay, so last week we covered Altria, ticker symbol MO. That's the graph you're looking at right now. If you haven't seen that video, check it out. I show you how you can use the strategy of reversion to the mean to earn solid returns. In that video, we're looking at, maybe midterm, um, a doubling up of the stock or near doubling up of the stock to get to a normalized value. All the meanwhile, you're getting about an 8% dividend yield, which I believe is safe. Um, this week, we're going to illustrate how reversion to the mean can sometimes be a trap. It's important to do your due diligence when you're investing in stocks, and we're going to get into that a little bit. I'm going to illustrate that point using the company CVS, ticker symbol CVS. And at the end of the video, I'll recommend a much better stock. So stick around for that. We'll also talk about how Amazon made me cry. So that'll be fun. So here, let's just go right to CVS. We're looking at them. I'm going to cut off a couple years here. We're going to look, this is 2017. I'm going to take the stock price off. I'm going to take the normalized PE off. So again, this green shading is the earnings over time. So we're looking back to, this is 2001 or the end of 2001. I have the .com bubble cut off for the purposes of this video. And then we're going all the way to the end of 2017. So you can see a nice trend left to right of earnings growth. We're using adjusted operating earnings. And then this white line you see is the actual dividend paid out over time. Important to note that it looks back from 2013. It starts getting increased every single year. You see that also through the Great Recession. This shadowed area in gray is the Great Recession. And not only did earnings increase during this time, we also have the dividend growing over time. Not many companies were able to do that during this time period, but regardless, the stock price still dropped significantly, and I'll show that in a minute. So this presented a wedge deal, which we talked about in last week's video, and yes, I am stealing that term from Meet Kevin. Okay, so let's throw on the stock price and the normalized PE. So over this time period, the stock price correlates with this blue line. So if it gets below that blue line, it becomes cheaper relative to itself, and you can presume that you'll get some reversion to the mean over time. You'll earn more money had you purchased the stock when it was overvalued over this normalized PE ratio. That's the price to earnings ratio. And you can see here back in 2015, mid 2015, I got very overvalued and there was reversion to the mean. You'd have to go look back during this time period and see what factors related to this fall in share price. However, it was probably it was inevitable because it was very overvalued, trading at a 23 PE. That's almost pre-recession prices. You'd have to probably go back to the .com bubble to see something higher than that. Again, you have what looks like a wedge deal here. You have share price dropping. Let's put from peak to trough here from the perspective of someone back in 2017 anyways, which was me. I bought this stock back then. So from the end of July of 2015 to August of 2017, it had a drop in the share price of 28%. Meanwhile, earnings were growing during this time. You had the dividend being raised each year pretty quickly. Um, the yield at this time, had you purchased the stock, which I did, was probably around 2.5% and growing quickly. So let's just go to the performance chart. You can see here the annualized compounding dividend growth rate for the 16-year period was nearly 20%. So that just looks phenomenal. And again, even if you're forecasting that we're going to have our earnings recession uh, through the Great Recession, the dividend growth was phenomenal. 45.4% going in, 14.3% during, and then 15.3% coming out. And you can see it continue to grow very fast. So the idea is, you buy it at that 2.5% in 2017, and it's gonna uh, be worth a lot more over time. And just another way to illustrate that, I have this set for DRIP or dividend reinvesting. So, had you invested $10,000 back in the end of 2001, you would have had 681 shares, and that would have paid out $78. And if you reinvested that $78 to buy more shares, and you did that each year as the dividend payout was increasing, um, back in 2017, your 681 shares would have accumulated to 816 shares just from reinvesting those dividends. And then your $10,000 investment would be paying you $1,600 a year in dividends. It's quite nice. And it was easy for me, anyways, or mistakenly easy to extrapolate that forward in 2017. Um, so let's go back to the historical chart. Oh, and if you don't know, CVS Health Corporation, ticker symbol CVS, I figure most of you should know. It is a drugstore chain, a popular one here in the United States. The problem with CVS and the problem that reversion mean can do, it looks attractive and sometimes it can be a trap. There could be a very good reason why, for the inevitable future, that the stock will continue to go down because the business model is no longer the same. What happened here at the end of 2017 is that CVS announced a merger with Aetna, which is a major health insurance company. Now, listening to the earnings calls and interviews with the CEO, they actually have, I think, a really good business model planned for the company, and it could still be attractive for investors. But given the current political environment we're in, the market has been skeptical of future earnings um, for this company. And that's because if we are going the route of government sponsored programs such as Medicare for All, that basically makes this business model obsolete. I don't even know what will happen, but it's not going to be good, most likely. Now, let's push this forward here so we can see what the stock has done in the last couple years. So it went down 28% from that peak in July or August of 2015 to the time I purchased it, and then it went down another 28%. And you can see it's gone up since this bottom here. That might be just a fake a fake head fake reversion. I am not confident that that trend will continue, but if you're just playing a reversion to the mean play, I'm gonna push this forward so we can see analyst projections. If you're playing like the reversion and mean play, it's easy to say that in the future, midterm to near term, that you have what looks like the Altria stock, where it can double up over the next year or two, or maybe 3 years. All the while, you're getting a nice starting dividend of 3.18%. That, of course, is growing pretty quickly. However, since the merger, that dividend has been frozen at $2 per share, and analysts are not projecting that dividend is going to be raised anytime soon. I think there's a lot of uncertainty with the stock, especially like I said, it's a political uncertainty. Two of the top three candidates running on the Democratic side are most likely going to do everything they can to implement a Medicare for all healthcare model, which would be detrimental to a company like this. Now, whether that comes into fruition or not, I mean, that remains to be seen. I think this becomes a nice reversion to the mean play if you get a Trump presidency or any Republican, if you know, if he gets impeached, or even if you get a Democrat that's not planning for Medicare for all type thing. And then there's people that think even if you get a Bernie Sanders or Elizabeth Warren, that it might be years or it might not even happen, regardless of who gets into office. If that's the case, even if they do get in the office, if you believe that, I mean, it's still going to trade at a very low PE during their presidency. So the bet here is that it's high risk, and I think potentially high reward. But there's a better play than this, and I'll get to that towards the end of the video. One thing to note, and I'll show this in the other stock as well, is that analysts have been very good at predicting the earnings for this company. Often it's 5% they're off or less. That's very accurate for analysts. So you can be pretty confident when you're forecasting future earnings with this company that they were off by 10% in 2018, but it was to the upside. So that's good. However, the stock, they beat by 10%, but the stock went down. Again, that looks like a good reversion to the mean play. I'm just looking at the normalized multiple here. We'll keep the PE, we'll keep it right below 15. The historical average is around 17. Current stock price trading around $63. You extrapolate forward a year and a half, year and a quarter, you can see a nice return. If it gets a higher PE, which certainly can happen, again, you're getting a nice total return there. And all the meanwhile, you're getting a nice dividend yield. That's all well and good. I just don't think this is not like the Altria stock I showed you last week. But I wanted to compare this on a more apples to apples basis to show you that you can get this potential high reward with a stock that is much less risk. And we'll get to that in a second. But first, I want to show you, I was watching Amazon Prime Original, and it's not like a really sad show. It's more like dark humor. It's like a psychological sci-fi thriller, I'd say. I find it fascinating, but it did make me cry. I want to show you guys teaser trailer, just a minute here.
Alma, remember what you said about silence the first time you heard it?
I didn't know it sounded so alive.
Some people's minds are more capable. They can see more, they can feel more, they can know more. What you have is precious. We need to carefully develop your potential.
Am I losing my mind, Dad?
No. Well, yes and no.
Okay, so super interesting. I loved it. I watched the whole season in like one sitting. I thought it was great. One reason I'm bringing this up is because I want to tease maybe a future video. This is Amazon stock. It's very hard to predict Amazon's growth. It grows extremely fast. It doesn't really matter if you buy this thing cheap or expensive relative to itself. You hold it long enough, it has just been a great investment. One thing I wanted to point out, on a EBITDA per share basis, EBITDA, it's not important you know what that is, but it stands for earnings before interest, tax, depreciation, and amortization per share. For this, I just want to show you it correlates extremely well to this, and this has been the biggest divergence recently. The stock is traded down about 15% from its highs back in August of 2018, and it looks cheap on this basis. One thing I wanted to bring up to you guys is, have you found a way? Let me actually, I want to see what this looks like cutting off the .com era. All right, yeah, so about the same. Looks about the same. Do you guys know of a good way to estimate EBITDA, forward-looking EBITDA? I haven't, or I haven't really looked into it. But I saw this chart and I thought, all right, I decided to look at this chart after I had watched the show. And then, full disclosure, I bought my position. It's my second largest position in my portfolio is actually Amazon. And I started purchasing it in 2017. My average share price, I think it's high 900s, might be right around 1,000. So I've had some nice returns here, even though the stock has been down over the past year. I'm up about 80%. Amazon's a company I love and use. Anyways, that's not what this video is about. Maybe a future video. Now let's go to the company that I want to compare CVS to. Walgreens Boots Alliance, ticker symbol WA. If you know the company CVS, then you probably know Walgreens. They're competitors. It's another drugstore chain. It's almost the exact same store. I just want to cut off some stuff here to make this look prettier. Boom. Take off the normalized P. Let's take off the stock price. So again, you have a nice left to right graph here. You can see the earnings growth over time. There's periods where it grows very fast and periods where it's slower. It did lose a little bit of earnings. I don't think this company is as good as CVS, but when you're investing, sometimes investing in the better company isn't the better stock. And right now, I think Walgreens is the much superior stock. We'll get to that in a second. So again, you can see the dividend growth here over time has been excellent. They have never cut their dividend, and again, through the recession here, you have dividend growth, which is excellent. Let's just check out the performance over this time. The compounding dividend growth has been 14.2%. Now, the time period I showed you for CVS was different, so don't read too much into that. But you can, over this 19-year period, 14% is phenomenal. You're currently getting a dividend yield of 3.4%. And everything you see, just to point out, everything this shaded green above the white line, that's all earnings on top of the dividend. So you could presume that the dividend is safe to grow in the future. However, when you're trying to determine dividend safety, there's other metrics you want to look at, not just this, but we'll save that for another day. Let's throw on the price and let's throw on the normalized PE during this period. We're going to cut off the expensive part of this graph. We're going to take out the recessions. All right. Interesting enough, the normalized PE is like right on this growth rate right here. And again, it's very similar to the CVS chart. The whole healthcare sector has been pushed down because of political uncertainty. And peak to trough here, not exactly trough, but close to it, to current price, we've had a drop in share price of 37%. Actually, it's more than that. It's because this does include dividends, so the actual share price has gone more than 37%. After dividends, it's down 37%. Now, the difference between this company and CVS is that it doesn't have the headwinds of a Democratic president changing the structure of the healthcare industry. Now, if a Republican or Trump or a non-Medicare for all candidate wins, you're going to get the same reversion to the mean as you are with CVS. And I would expect that analysts would adjust their future projections even higher. So 73% might be actually a return from here, might actually be very conservative. Now, if a Democrat does win, and let's just say they're able to implement Medicare for all, that just means more people will be able to buy products from Walgreens. They'll be able to fill in their prescriptions. More people will be able to purchase medical devices. That's only going to help Walgreens. So it's really a win-win for Walgreens compared to CVS. I would definitely stay away from CVS if you're interested in a play in the healthcare sector. This is one of the ones that to me has a lot of upside. You're gonna get starting yield here of 3.4%. It's growing at a nice clip. It seems very safe. You're gonna get a nice reversion to the mean. There's a lot of pressure on the price just because the whole healthcare sector is down, but it I don't think it really is going to affect Walgreens in the future. Just want to show you analyst scorecard. So just like CVS, with the exception of here coming out of the Great Recession, it's been analysts have been able to predict the earnings for this very accurately. And again, their biggest beat was last year by 8.5%. There, 8.64. So this is what I like. Again, reversion mean can be a trap sometimes. I see that in CVS. I do not see it in Walgreens. And I went over ticker symbol MO Altria last week, which I think is a great, phenomenal play right now. Check out that video again if you want to see more about it. Now, let me see. So there's a lot of recession talk going on over at CNBC right now. A common suggestion I hear is to get into defensive stocks. Not defensive as in like Lockheed Martin or stocks like that, but stocks that would do well in an earnings recession. I have a contrary opinion on these stocks. It's the stocks we're talking about are consumer non-cyclicals, utility stocks. If you want me to do a video on those, just leave a comment. Or if you'd rather me to find value in high growth risk stocks like Amazon, Facebook, those type stocks, I can do that. Just let me know in the comments. If there's something else on your mind, let me know. If you have questions, let me know. If you found value in this video, give me a like and hit the subscribe button. It really helps. Appreciate it. I will see you guys next week, probably. See ya. Bye. Thanks.